It is my pleasure to welcome Brian Domitrovic to the show. He is with the Laffer organization, and you've certainly heard me talk about Arthur Laffer over the years. He's also the author of several books, including the most recent, Taxes Have Consequences, in Income Tax History of the United States. So we'll dive into that and his other works. Brian, it's great to have you coming to us from Nashville, Tennessee. How are you?
Very well. Thanks, Jason, for having me.
Yeah, it's good to have you. So first, since you are so involved with Laffer and supply side economics, and I'm guessing that all of your books are written in that vein because you teach this topic, explain to our listeners, what is the Laffer curve and how it influenced the Reagan Revolution and, supply side economics? Let's start broadly there and go from there.
Sure. Yeah. The Laffer curve is probably the most consequential curve in economics of the last half century. It's just a plot. On one axis is tax rates, and on the other axis is tax revenues. And Arthur Laffer showed, when he first drew it in 1974, that at some point, if you raise tax rates, tax revenues are going to go down. Robert Bartley, the Wall Street Journal, called it a McDonald's arch lying on one side. It goes way out as you go up, and then it goes way back as you go really high up. So the point is that there are high enough tax rates that if you cut them, you get more revenue. And he first drew this, lore has it, in December 1974 on a napkin, a cocktail napkin at the Two Continents restaurant before the chief of staff of the President of the United States, Don Rumsfeld, and his deputy, Dick Cheney.
Okay, so he was not with Ronald Reagan when he drew that on the napkin, right?
No, the napkin was during the Gerald Ford presidency and was certainly with Dick Cheney, who was deputy to the chief of staff, and may well have been with Don Rumsfeld, who was his boss, in the Ford White House. And it was also with a reporter from the Wall Street Journal, Jude Winniski, who's the only one who remembered the incident, and he's the one who told us about it 4 years later in 1978. I have all of Arthur Laffer's archives, and I found his derivations of the Laffer curve several years before that in mathematics. And so we actually have those, his actual handwritten Laffer curves from like 1973 before the napkin.
Right. Very, very interesting. There's a lot of mythology about that. And so it's great to hear the real story. But you called it the most consequential thing in economics in the last half century. And I would agree with you, because before that, really, especially those on the left, thought of taxation as kind of a zero-sum game. You raise taxes, you get more tax revenue, right? That's sort of basic thinking. But Laffer and the Laffer curve prove that wrong, because when you raise taxes, you actually suppress economic activity. And that was a pretty radical idea at the time, right?
Yep.
Speak to that.
Sure. Well, I think we can basically prove it was the most consequential graph, because for 50 years, beginning in 1932, the top rate of the U.S. income tax, personal income tax, was never lower than 63%, and it was often above 90%. I mean, in 1980, when Ronald Reagan ran for president, the top rate of the income tax was 70%, 100 minus 30. So without the Laffer curve, you have to assume that if you cut tax rates like crazy, like by 40 points, well, you're going to lose 40% of your revenue. The government was running a deficit in 1980. What are you going to do? Lose 40% of your revenue? Well, that's what Reagan did. He cut the top rate from 70 to 28, down 42 points. What happened to government revenue? Went up.
Right.
So, yeah, I mean, the Laffer curve got us out of a 50-year sclerotic cycle of not thinking we can cut tax rates from their super high levels above 63%.
Okay, but of course, there's always a lot more to it, and the tax code is incredibly complex. Even back then, it was complex. Now it's magnitudes worse. But even though the top rates were higher back then, there was a whole different set of deductions and ways that you could game the system. I mean, of course, everybody games the system nowadays, too. If you could just speak to the reality of marginal tax rates versus actual tax that people pay, right? Because even though the marginal rates were much higher in the past, they did have a lot of deductions that incentivized, malinvestment. I mean, we certainly have that still, but it's different, right?
Sure. Well, I mean, we certainly know that tax revenues have not changed in any significant sense. In the 1950s, when the tax system began at 20% and ended at 91%, the total tax revenues was 16% of GDP. Well, wait a minute. I mean, the tax rates take total income. Corporate rate was 52%. Aren't you taking like 50, 60% of income? No, it took 16%. So obviously there were a lot of deductions. I mean, the total amount of revenue was below the bottom rate of the income tax, which everyone had to pay. And then in the 80s, after Reagan cut tax rates, the total tax take was 17%, really materially no different from the 1950s.
And now our GDP is what, around 25 trillion, and we get about 4 trillion in tax revenue, I believe. Those are very rough
stable.
numbers.
Doesn't matter what tax rates are. You're going to get the same revenue.
Okay, but I haven't calculated the percentage of that. Is that 17%? I mean,
yeah, more or less. Yeah, sure.
Really? Wow, that's amazing. Yeah. So in essence, people are only willing to part with about 17%. Right?
Yeah. And that's still, although that's with a massive tax code, as you pointed out. I mean, that's with a 70,000 page tax code with all the legal amendments. Yeah. So if you lower tax rates even more, you'll probably eliminate the entire tax code. Andrew Mellon said in the 1920s, a successful civilization that people really buy into could get complete acquiescence to a 10% tax rate. He said anything after 10, you're going to start to see a tax code develop for deductions.
One of the funny things about that is with tithing, 10% is sort of the norm, right? If God can live on 10%, the government can certainly live on 17%. Yeah.
And Mellon asked that. He said, well, religion is a more powerful force to people personally, spiritually than government. Right. And so if the most religions had ever been able to do is get their people to volunteer 10%,
right.
The government can't do that. The most it could expect from a really invested patriotic citizenry is 10%. What's it doing with 91% tax rates?
Yeah, right. That's interesting. Okay, so tie this in with supply side economics, because during the Reagan Revolution and Arthur Laffer was in this camp, and you heard his name associated with it all the time. Supply side economics, supply siders. Explain to our listeners what that is and how it ties in with the Laffer curve.
Yeah. The tax cut tradition, such as it was in the 70s, accepting the John F. Kennedy precedent of the 60s, which was fantastic, was that tax cuts should always be focused on giving people who are learning a very small amount of money, more money, either through a rebate check, and we've seen that in modern times, or through raising personal exemptions and introducing tax credits for low earners. And what Arthur Laffer and the supply siders said is, okay, that's going to increase demand. Everyone will have a little bit more money and people go out and buy things. But the people at the top who are producing those things are still going to face a frontier of taxation of like 70%. And they're like, I don't care if there's more demand. I don't want to make 30 cents on the dollar. So if you want more production, which is ultimately what GDP is, what economic growth is, you have to cut marginal tax rates at the top on the highest earners in a progressive system.
So trickle down economics.
Yeah.
Another phrase we heard a lot associated with supply side and the Laffer curve. The critics say the trickle down doesn't really work. It doesn't really happen. It doesn't really trickle down. What do you say to that?
Yeah, well, I asked them first why they're using that language. So in the 1980s, for example, the stock market went up 15-fold. So the Dow went from 770 in 1982 to 11,000 in 2000. GDP growth in the United States in the 1980s was usually over 4% per year. And then the 90s was over 4% per year. There were 40 million new jobs from 1980 to 2000. The net worth of the country expanded by something like, I've looked up these numbers. It's in the trillions, because your mind starts to boggle at this. So, 10, 20, 30, $50 trillion net worth increase. So I want to know about that word trickle. Yeah. Every statistic I just pointed out has nothing to do with trickle. It has to do with thermo-dynamic rush. I mean, it has to do with cosmic, huge magnitudes. And trickle's not the word you want to bring to that fight.
Okay, so tell us about the, what did you call it? Thermodynamic rush?
Yeah, that's John Rutledge's term. He was Ronald Reagan's economic forecast.
I haven't heard. Okay,
he said, this is not trickle down. It's like thermodynamics in physicochemistry. I mean, when there's a vacuum and there's a force, man, is that vacuum filled up by that force.
Right, yeah, nature.
You cut those tax rates in the early 80s, boy, was there a rush into real investment, and it created 40 million jobs. What's this about using the word trickle? Then you don't even understand what's going on. I mean, you're in the wrong decade if you're using that word in the 1980s.
Yeah. So I can't help but compare this discussion and this philosophy to all of these multinational huge companies that have just taken trillions of dollars offshore because they've been incentivized to, unfortunately. And with the Trump tax changes, some of that money was getting repatriated.
Yeah.
How does this supply side Laffer curve and really the idea that taxation is not the zero-sum game the left thinks it is, how does that apply to what we have now with these corporations that have just taken a lot of, it's just so unfair. And Pat Buchanan was on the show and he wrote about this in one of his books. I remember, how these companies are just not loyal to any nation. They get their money mostly from the American market. That's their biggest consumer base, right? But then they offshore it. America doesn't get the benefit of the tax revenue it should have. How can we apply this to that situation? Kind of maybe where are we now and where should we be on that?
Okay, just a deep background point. I mean, I don't think we should assume that tax revenue is a good thing. It's best if government shrinks as the economy really grows. So just that's a general comment.
I'm looking at it from the government's point of view.
Right.
Okay, that they, like any organization, wants to grow, which is unfortunate. We don't want government to grow. Right. But that's the way they think, right? They think we want more revenue, we want a bigger slice of the pie, we want to grow our influence. Yeah.
So, I mean, I have a specific answer to the corporate tax issue, but I should say that a government of good character should want to shrink. So a government that wants to grow is a government with bad character. So a government...
We have what we have, but
right. An economy should grow, a private economy should grow, and the government should be willing to shrink as a proportion of that economy. And that would be a sign of good character. At any rate, the United States in 2017 had the highest corporate tax rate in the world. Maybe, the second or third highest, whatever. It's hard to measure with the total add-ons. And that's when Donald Trump just surveyed in his tax bill and just said, what's the highest marginal rate in our system? And I'm going to cut that one. That's, again, what Robert Bartley of the Wall Street Journal used to say. Find the highest marginal tax rates and cut them. And that's exactly what he did. He cut it from 35 to 21, and immediately there was a rush of corporate profit repatriation. I mean, the very moment the bill was passed, all of a sudden, some colossal sum of money. I forget what it was. We wrote a paper on it. So, if you have a high tax, you have the highest corporate tax rate in the world. Guess what? Corporations are going to book their profits offshore. Of course they are. Well, there's a simple solution to that. Cut the corporate tax rate. That worked, and a lot of money came right back here and was subject to taxation at that new lower rate.
Yeah. Let's dive into, and I agree, of course, let's dive into the book a bit, your most recent book about the history of taxation in the U.S. And you mentioned something off air before we started about property taxes. I think it was property taxes and the Great Depression. Maybe you want to start there.
One thing we go into extensively, and taxes have consequences, is the kind of unknown, immense tax reason that the Great Depression happened. In fact, we go so far as to suggest that really the Great Depression happened because of tax increases. I mean, there were at least three major domain tax increases, 1929 to 1933. The first was the Smoot-Hawley Tariff of 1930, biggest tariff in American history, traded products with the rest of the world. Second was the Revenue Act of 1932, effective January 1st of that year, which raised the top rate of the income tax from 25 to 63%, 150% increase. That's ridiculous. But the biggest tax increase of all was in the biggest area of government. Local government at that time was bigger than the federal government and state governments combined. And that's traditional in American history. And they raised property taxes beyond all belief in the late 20s and the early 30s. And that really was the root of the foreclosure crisis, which then gave us the banking crisis, because the principal asset on the bank's balance sheets was mortgages. And the phenomenal increases in property taxes in the early 30s just made it impossible for people to keep their homes. And so then that ruined the banking assets, which ruined the economy. So we go so far as to suggest that the local property tax was the central villain and the very cause of the Great Depression of the 30s itself.
Wow, I've never heard that before. I mean, I've had Amity Schlaze on the show, and she's written extensively about the Great Depression. Is that solely your idea? I mean, I just haven't heard anyone say that before. That's
well, yeah. So, Great Depression is kind of, as Ben Bernanke says, the holy grail of macroeconomic history and all that kind of stuff. I mean, Amity Schlaze's work is just incredible. I mean, The Forgotten Man is just a nonpareil of correctly revisionist history. And it's the thing about that book is how mad it gets the left, because the left knows that here is just a fantastic work of history and they can't handle it. Yeah. So no, we know that Milton Friedman monetarists and the anti-gold standard people have really monopolized the historiography of the Great Recession. It was either capitalism or it was the monetary system. And I'm like, well, where's the tax analysis? Now, Jude Wanniski in 1978, in his great book, The Way the World Works, really highlighted the huge tariff increase as causing the Great Depression in 1930. Well, we have just followed that lead. Again, this is in the supply side tradition. This is all within our Reagan tradition, the people who advised Reagan, who started that stuff in the 70s. They are the ones who said, hey, you forgot about taxes in the Great Depression, and we're just building on that tradition. Is that percolating outside ourselves into scholarship? I don't think it is. Mm-hmm. I also don't think we're wrong.
Yeah, very interesting. Okay, tell us more about the book.
Yeah. So it's a complete history of the income tax in the United States. And as you may know, we only started the income tax 110 years ago by constitutional amendment, the 16th Amendment to the Constitution, 1913. And it's a history.
Right near the time the Federal Reserve started. And
yeah,
probably not a coincidence. Yeah.
2 months before the Federal Reserve started.
I know, it's amazing.
Income tax is October, the Federal Reserve was December.
Can you, before you go into the book, can you speak to that? Because, of course, you know about MMT, and we've done some shows on modern monetary theory, which, is a fantasy, if you ask me. But they do make a few good points, like any fantasy. And having the central bank and the tax system, it gives them that circular. It's kind of brilliant, really, if you think about it, right? It gives them that circular thing, create fake money out of thin air, and then create the demand for the fake money out of thin air. So everybody has to use it, right? That completes the circle. Mm-hmm. Anyway, speak to the Federal Reserve and the tax code, if you would.
Yeah, it's funny you mentioned that. That actually is the thesis of my first book, Iconoclast, which is a history of the supply side economics. It's that the first chapter of that book is called 1913. But that is the year that the United States acquired for itself the instruments of monetary and fiscal policy. It was that year. Mm-hmm. Monetary policy via the Fed, fiscal policy via the income tax. Mm-hmm. Prior to that, it had neither. And how had the American economy done? Well, it became the greatest economy in the world in the greatest era of the Industrial Revolution. So prior to 1913, we obviously didn't need either institution because the United States became the single greatest thing ever in economic history without those institutions. Mm-hmm. So the one thing I'd say about MMT and fiscal and monetary policy is, yeah, it's very clever how the federal government does that. But we know what happens. There's a tremendous efficiency loss to the economy because the economy knows itself how to create money and it knows itself how to keep small government going and not intrusive. So if you say, well, we're going to appropriate for ourselves the money creation power, and we're going to appropriate for ourselves the means of funding government and setting the size of government, well, then the economy won't be as efficient. And that's what we've experienced, much slower growth since 1913 as compared to the heroic rates before.
Mm-hmm. Yeah. Okay. All right.
So I simply asked, what's the use of having fiscal and monetary policy? Oh, it's all negatives. Yeah. Right. Well, then I don't want it.
Yeah. Okay. So I want to let you go into the book. Forgive my diversions, but the book is just fascinating. And I mean, taxes do have so many consequences. It just changes the whole context on which we relate and engage in commerce and just the way we think. It's an amazingly powerful part of life.
Yeah. Well, I mean, I can't imagine real estate because real estate is what's been completely dominated by tax decisions, probably more than any other industry, I might suggest.
Good point.
I mean, with depreciation in the 50s, it was just crazy.
Yeah.
You had to be a real estate firm in the 50s when you had to be. Even if you're a regular firm, if you weren't taking advantage of the excess depreciation losses in the 50s, you would fail as a business. And you could be making widgets. I mean, you could be making stuffed animals. It didn't matter. You had to be a real estate firm.
Yeah, so when did that start? I always call depreciation the holy grail of tax write-offs because it's a non-cash write-off. It's just an incredible benefit. When did that start, though? I don't know the history of when that became a thing.
I mean, it stumbled. I mean, the tax writers had no idea what they were doing, of course, for the first 20, 30 years of the income tax. It's a brand new thing. They'd never had it. So there was no system. There was no profession that ministered to this. And the profession that grew up first was the tax bar, which is how to avoid taxation. And they just ran circles around the tax writers. And that's what our book, the first few chapters of the book, is how utterly impossible it was for the federal government to raise more money by increased tax rates. Because then the tax bar would just come in and just eliminate taxes for the rich, especially in the 30s. Another reason we had the Great Depression. So depreciation was in its bizarre infancy, kind of pathetic infancy in the 20s and 30s. It was really in 1954, the Tax Reform Act of 1954, that the modern accelerated depreciation system was instituted. And that had all sorts of intended consequences. And that's really what got going companies having real estate arms where they could book their profits.
Very interesting. So, what do you think about that? I mean, I always call income property the most tax favored asset class in America. And, of course, we have lots of real estate investors listening. What do you think about the real estate tax code, all the different things as it relates to real estate?
I wouldn't dispute that. I mean, I'm not as expert on the kind of the oil severance taxes, but they might be a competitor. I don't know for, the most tax advantage, but I'll go with real estate. Now, I should point out that it depends what the tax rates, the statutory posted rates actually are. So in the 1950s, when you had an accelerated write-off, you could take, a 200% or whatever off a 91% tax rate or a 52% corporate rate. I mean, that really mattered. You can see this in the straddles, the incredible real estate straddles in the early 70s, but that's when tax rates were 70%. I don't know, when the corporate rate is down to 21 and the personal rate, say, was down to 28 as in 1988, the value of those deductions in completely reorienting your business strategy towards having a real estate arm goes down. I mean, there are costs if you're making stuffed animals to having a real estate arm for your business that's not part of your core competency. Right. But when the corporate rate's 52%, you get a deduction against that. You're like, okay, but if the corporate rate's 21 or 15 or 10 or 5, is it worth completely reorienting your strategy? So the most important thing is the top line rate.
Yeah, it creates mal-incentives and mal-investments. Not everybody should be in real estate, but that's the incentive, right? Yeah. So
you weren't in real estate by the late 50s. There's no way you could make money as a business in this country.
Wow, that is a mind-boggling statement. So all of these businesses that were really in another business had to be in real estate because the incentives were so good, right?
Yeah, because the real estate depreciation, your actual depreciation could never meet the deduction. So you had to book other profits. And if you didn't, your competitor was doing it and had better margins than you did.
Yeah. Wow. Incredible. What other things in the history should we know about?
Yeah. So main theme of the book is that the history of the income tax is also very much a history of tax sheltering. And that the hero of the book is the top 1% of earners in the United States. And we point out that when tax rates are high, they just pull out every ingenious stop they can to legally shelter their income from taxation. And the government can't do nothing about it. It can't do anything about it except applaud and say, yeah, you got us. And when the government lowers the top rate of the income tax, particularly dramatically, the rich say, you know what, forget about shelters. We will come and declare our income fully to you and pay you your taxes you want. So it's a much more efficient system. You get the top 1% doing what they're best at, which is activity in the real economy when you have low top tax rates. When you have high top tax rates, you just get whipsawed by what they do to keep their money. And the poor do very poorly when rates at the top are high because the rich aren't trying to get going in the real world. And the poor do great when top tax rates on the rich are low.
And is that mostly because of employment? Are we talking about the Phillips curve now? Or, obviously businesses, when they're incentivized or they just have, they're incentivized by having extra revenue left over, right? And not paying it in taxes because then they can do things and they want to expand and grow. Is that what we're talking about? Like hiring or?
We're talking about GDP, certainly. So, the economic output of the country goes way up when there are top tax rate cuts at the top. And when there are top tax rate increases, economic output goes way down. So we're also talking about employment. As I pointed out, the Reagan administration, there were 40 million new jobs from 1980 to 2000, an entire era of tax rate cuts and then finally government spending cuts. So yeah, you have an independent citizenry at all class levels making it on their own when the rich are doing their thing. And attracting immigrants who come to the country to work and become American citizens and all that stuff, like before the income tax in 1913. And when you have high top tax rates, you have government welfare programs, the New Deal most famously, the welfare state of the 60s, which was inappropriate to that tax cut era, but it was conceived of in the 50s during the high tax rate era. So yeah, you have a very vigorous population at all class levels doing their thing when you have top tax rates that are low. And you have a dependent, soporific, crime-inclined population, sometimes even starving, is in the 30s, when you have top tax rates at the top that are high.
Interesting. Okay. Give us something else from any of your books, any of your work. You've got 6 books, right?
That's right.
I think one you wrote about JFK and Reagan.
Oh yeah, with Larry Kudlow, I wrote a book,
Yeah,
JFK and the Reagan Revolution. Mhm.
exactly. That was interesting. What's the tie in there? Tell us about that.
Oh, sure. Well, John F. Kennedy is the predecessor to the Reagan Revolution. I mean, he had a huge
A Democrat.
marginal, a Democrat.
Yeah.
In 1963, he introduced legislation which got passed the next year, a couple months after the assassination. Well, it was passed in the House in September, right, a couple of days after the I Have a Dream speech. He said, we're going to cut marginal income tax rates by 30%. The top tax rate was 91. That's absurd. The bottom rate was 20. That's too high for working people. We're going to cut those. We're going to cut them to 70. He wanted 65 at the top, and we're going to cut it down to 14 at the bottom, 30% rate cut across the board. And he just willed it into existence. Passed the House in September 63, was succeeding in Finance Committee in the Senate in 63 at the time of the assassination. And then Johnson had no choice as a memorial to the slain Kennedy. And the growth rate was 5% the entire 1960s, having been 2.5% in the 50s when we weren't doing this. So it was a fantastic success. And it was misrepresented because Kennedy died and couldn't defend it in his own words.
Right.
So the left took advantage of the Kennedy assassination to misrepresent the tax cut as some kind of like it wasn't the marginal tax rate on the rich, which of course it was. And then Reagan finally and Laffer finally just said enough of this. Let's just do a Kennedy tax rate cut again. They did that in 1981 and off to the races again.
Right. But, I mean, Johnson, we can place a lot of blame on LBJ for his Great Society and, really just making the welfare state giant, right? I mean, that's a fair point, isn't it?
Oh, yeah. The poor man, LBJ, had no idea what he was doing. He completely misunderstood the pillar of his own economic policy. So he became president on November 22nd, 1963, having been shut out of the Kennedy administration. And then Kennedy had this huge bill that was the signature legislative accomplishment of his presidency. Just passed the House, is about to pass the Senate, this income tax rate cut. Johnson had no choice but to pass it. Okay, doesn't mean he understood it. So he signed the bill in February 1964, and we have his tapes. He actually thought that the full effect of the bill in the economy would come in a couple months. Like there would just be a boom and then it would be gone and there would be poverty again. So he didn't understand when you permanently lower rates, particularly at the top, the long-term investment profile of the economy completely shifts and everybody pours into long-term investment. So his gross misunderstanding of his own economic policy led him to install the Great Society in 1965. Why would you install a poverty program when you just have a permanent jobs boom because of your tax cut? So he was just completely at sea about his own economic policy, and therefore he was laughed out of office in 1968.
Yeah, well, thank God he didn't run again.
Yeah, right. Yeah, I shall not seek. Yeah.
Yeah, right. Absolutely. Well, Brian, this is a fascinating conversation. I just want to give you the chance to share anything you'd like to share, a question I didn't ask, whatever you'd like to share with people, whether it be history or prescription for the future, whatever.
Yeah. Well, one thing we do point out is in tax debt consequences, I know, and this is in my other work too, is that the American people really respond to the prospect of the American dream. I mean, it's their birthright. They love the American dream. And if you give the American people the chance to have an American dream by getting out of the way, they just go and take it. So there are really no costs to tax rate cuts. When you have tax rate cuts, the American people just come into their own. And I'd say that's kind of the lesson of modern American economic history.
Yeah, very good point. Brian, give out your website so people can find your work.
Yeah. Well, we have the LafferCenter.org, and I also have globalmonetarism.com as my own personal website.
Excellent. Good stuff. And the books are available in all the usual places. Brian, thank you so much for joining us.
Okay. Thanks for having me.